first topic for today, which is the investment appraisal. Investment appraisal is, we can also call it capital investment appraisal. Okay. Capital investment appraisal. It's basically long-term investments. You cover about the capital expenses and revenue expenses in your earlier studies. Revenue expenses is your day-to-day routine recurring expenses. So when we say investment appraisal, we are not talking about revenue expenses. We're talking about capital investments, like investments in machines, investments in plant, factories, upgradation, right? New projects, new products launching. This is the capital investment. Okay. So one of the area that comes under the responsibility of a finance department is investments. They are responsible to make sure the money we invested in the projects, they are suitable to the company. Reason being, look, because capital investments are very important for the business survival. Look, your investors, when they are going to invest in your business, right, they will look at a lot of things. One of the key things they will look at, where they're investing in. They're buying this business. They made a bad call. They should not buy that, right? People, people will basically react on your investment decisions. So if you made a bad investment, look, capital investment decision is not irreversible. You buy the plant, you spend millions on it. It's not possible that if you want to go back, no, we don't need. No, it's not possible. Once you invested, then you have to suffer the problem, right? So that's why it's very important. So why it's important? Number one, because of the long time scale. Capital investments. Why is important? Because capital investment require a longer period of time. Maybe it's cover 50 years of investment. You're investing in a new plant, a new factory. So time span covers 50 years, 30 years. Even 5 years is a big time. Okay. Nobody knows in 2020 beginning that this COVID pandemic is going to affect us. We don't know about this. The world is uncertain. Okay, we might predict what is going to happen within next 1 year, okay, let's say with little bit certainty. What about 5 years? What about 10 years? What will be the inflation in 10 years? What will be the unemployment level in 10 years? In 10 years, there may be 2, 3 governments changes, right? So the one key reason why the investment appraisal is important because of the long time scale. Number two, big investments required, the big, maybe millions and billions of dollars of money you need. And money investment requires now all the money to invest in the plant and factory now. But benefits, you will not get all the benefit you will not get now. You start getting benefit from year one. And maybe it take years to recover your money back. So because of that, these investments are very important for the business survival. If you made a wrong investment decision, right, it might cause the business liquidation problem as well, right? So keep this in mind. So that's why these decisions are made by the board of directors. And these decisions are not you will made within a month. No. These decisions take a longer time to decide. So you have different investment opportunities available. You scan them, you check them, you will see which one is feasible for you. You will debate about that, and then you will choose, okay, we should go with that investment or not. Okay, so what we are going to learn in investment appraisal section, there are a lot of topics we have to cover in this section. The first topic that we are going to start today is basically our investment appraisal. We will learn about certain techniques. We will learn about some techniques that will help us to understand whether our investment is suitable for us or not. Okay, and these techniques Three of these techniques you already cover in your basic papers. Okay, what is this? Net present value approach, internal rate of return, return on capital employed. Maybe you learn this as a ratio, but now, yeah, now we will use it as an investment appraisal technique. And the payback period is the fourth of them. So we have these four techniques, investment appraisal techniques. First of all, in the first two chapters of investment appraisal, we will learn about, right? The NPV and IRR, we will go in much detail. Of course, not like what you cover in the basic papers. But okay, before going to start these four techniques, I will start with an example. Let's say, here's example. We have an investment opportunity today. Look, here zero mean today. Year zero is not a year, by the way. Year zero mean today date. Okay, we have an investment opportunity available. It's a long-term investment. It requires $50,000 today. And if we invest it, it results into these inflows in the future, right? If you sum the inflows, how much it comes? 65,000. And how much investment is needed? 50,000. So it's look like this investment is good for us, is feasible, suitable for us, right? Because it's generate return. But look here, we are missing a very important point, which is called discounting. Time value of money. Yes. A concept we need to learn in the beginning is time value of money. What that mean, time value of money? Okay. What that mean? The concept of time value of money mean yes, the let's say if you have, yeah, the power of currency, the money will not remain the same over the time. The worth of the currency is not going to remain the same over the time. Let's say the 100 dirham of today is not equal to 100 dirham after 1 year, right? The 100 dirham today is not equals to 100 dirham after 1 year. Yeah, what's the reason behind it? Yeah, let's look at the reason. What is the reasons for that? Okay, those said one reason is inflation. Okay, good. What is inflation? Inflation is the general increase in the prices, right? What problem in inflation will create? Yes, inflation will affect the purchasing power of the buyer, right? I mean, let's say my income level remain the same, and if due to inflation, if my expenses are increasing, no, I don't have the capacity to buy the same material or the same stuff that I buy before. It's keep on reducing my purchasing power. Okay, one reason is inflation, right? But inflation is not the only reason. I mean, look, let me ask you a question. Let's say I owe you 100 dirham, right? And I ask you two options. I ask you for two options. Let's say there's zero inflation in the economy. I gave you two choices. You can get your 100 dirham now, today, or you can come after 1 year and get the 100 dirham. What you will choose? No, there's no inflation, but still you choose no. Why? Second reason is risk and uncertainty. I'm offering you no. God knows what happened after 1 year. I have the condition to pay you. I have the intention to pay you or not. Nobody knows. Third reason is, yes, opportunity cost. that you need to invest. Like what? Look, if you pick today's option, if you choose today option, you can get the benefit today. Okay, you have money. If you simply invest in a bank, if you okay, you can get even the better in a return by investing it in a good investment. Even if you just simply take this 100 dirham from me today and invest in a bank, you will get 105, 106, 107 from the bank after a year, right? So because of these reasons, the worth of the currency is not going to remain the same over the time. This concept is known as time value of money. So same concept applies here. Look, we have these inflows, okay? This first thing is outflow for us. This 50,000 is outflow for us. But all of these are inflows, but it is going to happen in the future. Okay. This thing, this money we're going to spend today. But these we are going to get in future. They are not at the same timeline. Look, if I draw it on a timeline, all of these cash flows are on the different timeline, not different years. Look, if you have two quantities given at different like what we call it parameters, like okay, one is given in kilogram, others in gram. In mathematics, we can't add, we can't subtract, we can't compare until unless we convert both of them at the same level, right? So similarly, all of these cash flows we need to convert in 2 days time because we are going to make decision today. So we need to convert in 2 days time. Okay, so we will convert all of these cash flows in 2 days time. Then we are going to make a decision whether this decision is suitable for us or not, right? So converting a future value in present value, is it possible? Yes, it's possible. And this is possible through discounting, right? So we have a concept, we call it discounting. So what is discounting? Discounting is when you can convert future values into present value. This is known as discounting. Okay. And how is it possible? If you have a future value, if you have a future value, so you need to multiply with the discount rate that you will get with the formula of 1 over r, 1 plus r raised to power minus n. You will get what? You will get the present value. We have future values available and you multiply with this rate. What does R stand for? Cost of capital, rate of return. Look, the same I explain it to you. N is the number of periods. It may be years, months, whatever. Okay, so you do that and you will get the present values. Okay, let me explain now over here. How we can use this concept here. Okay, so these are the different cash flows, right? So what I do, I will take a discount factor. Discount factor. And we will find out using our cost of capital, using our rate of return that will be provided to us, let's say 10%. Okay, so when this discount factor we multiply with our these cash flows, we will get the present values. Okay, we will get the present values. Okay, this one. Okay, so how we will get this? This formula. Okay, like what? 10% is my return. So what's the way? 1 plus 10%. 1 plus 10%. Okay, if I just want to remove percentage sign, I can divide it by 100. 10 by 100 is 0.1. So I can write 1.1 as well. It's up to you, right? Okay. I can write 10% raised to power. If you write 1 plus 10%, then write in bracket then, because you're going to solve this in Excel sheet in exam. Or 1.1 if you want to take, then there's no need. 1.1 then raised to power minus n is this. This is my n. So I will give a reference of the cell. Here, zero discount factor is always 1, whatever the rate of interest, because anything power 0, 1. You know that. And similarly, I can find the discount rate for these years as well. Okay. So, so these are the first thing, these are the future values. And this thing we derive, okay, these are the future values. And these things we derive by doing the formula of 1 plus r raised to power minus n. Now, what we need to do, we need to multiply. If you multiply these both, you will get the present value. So 50,000 times 1, 50,000. Okay, so you see, this 14,000 that is coming after 1 year. Okay, if I see in 2 days' time, its worth is just 12,727. I mean, if you have today 12,727, and if you invest for 1 year, you will get 14,000. Simple. Similarly, 11,000 that is coming after 2 years, in 2 days' worth, its value is just like 9,091. So all of these we need to find in present values. And then we will find the total of them. It's a negative. What that mean? It's not worthwhile. It's not worthwhile. I mean, this investment, what that means, this investment is not giving me return. This investment is giving me return, but it's not enough just to pay the cost. Look, to start this investment, what I need, from where I bring this, buy debt or buy issue of shares. What I need to pay for them, cost of capital. How much it is? 10%. Understand? So if I bring 50,000, from where I will bring? From the investors. It will cost us 10%. So if okay, this project give me return. Look how much return it gives me. We find out 15,000. But after paying the cost, no, it's not even able to pay the cost of the investor. Look, if the NPV is 0, what that mean? We are not getting any return? No, still we are getting return. But we are just getting return just to pay the cost of the investor. That's it. Business will achieve nothing. So if this approach is called net present value approach. Okay. So one of the approach we have is net present value approach. Basically, I explain it to you here, net of present value approach. So what I find? I find the present value of outflow, which is already in present value. I find the present value of inflow, and I find the net of them. That's why we call it net of present value or net present value or NPV. So NPV is one of the most reliable approach that is used today world for the investment appraisal. We have many others. We have IRR, we have MIRR, we have APV, we have many other approaches. We will discuss few of them. But one of the more authentic and more reliable approach that businesses are using is NPV. Okay, why? Because it considers the time value of money in it. Okay, NPV is technically one of the superior method to appraise the investments. Reason? It applies the time value of money. It is based on time value of money principle. Number one, we did discounting. Number two, it considered the entire life of the project. We take all the cash flows here in this investment decision. Number three, we take cash flows, not profits. Do you know? The profits and cash are not the same. A business may have millions of dollars of profit, but no cash. You can't survive without cash. Yeah, profit is also important for your, because this is what you exist. But cash is even more important. If a company is in losses, but they have sufficient funds to live, they can continue. If you have profits in the books, but no cash, you can't survive. How could you pay your bills? How could you pay your salaries, your rentals, right? So it uses cash flows and it uses relevant cash flows. You know the relevant costing idea. We'll come to no detail, don't worry. Relevant costs. So why it is superior? It uses cash flows. It uses relevant cash flows. It consider the entire life of the project. It consider the time value of money concept. Because of these big reasoning, the time this NPV approach is one of the universally accepted approach to appraise the capital investments, right? And what we are doing here, discounting. Okay, we have one more concept as well. We call it compounding. You know what is compounding? What is your name? Sorry, Nasimul. Nasimul. Okay, you know compounding, Nasimul. Compounding. Yeah. Is opposite to discounting. Yeah, instead of minus and plus. Yeah, plus. So look, this what is discounting? Converting a future value into present value, right? I mean, you have a future value available and you want to convert into present value. This is discounting. In most of the techniques, all the techniques we use discounting, right? But compounding is also needed sometimes. Look, what is compounding? Opposite. I have a present value and I want to know what will be the future value of it. Let's say I have a money, a bank is offering me, invest with us, we will give you. So I want to know if I invest with a bank now, how much return I will get after 5 years, 10 years. I need compounding. So compounding is opposite for this, right? So what I do for compounding, okay, I want to find the future value, right? So this thing I will bring up here. So what become? Future value is equal to present value multiplied by 1 plus r raised to power n. So I will just remove the minus sign there, right? Okay. So that's the first key thing we need to understand here. Okay, now, because these are some basic concepts you cover already, but we need to go through all of them, right? So, and today's session, I will try my best to at least cover up all the basic sessions and do some practice questions from the revision kit, which is available to us. Okay. Okay. You know about annuity? What is annuity? Yes, it is same. Yes. Look, yeah. Look, annuity. What is annuity? Look, I'm taking the same example, but I'm making all of these cash flows same. Let's say I'm looking for an investment. It cost me 50,000 today, and it generate me 15,000 every year for the next 5 years. Okay, for the next 5 years. So if I see that, it gives me a positive NPV today, right? So what is annuity, by the way? By the way, when you have same cash flows for the limited number of time period, this is known as annuity. So what is that case? In that case, we can calculate our NPV in this way, the simple way that we use, or we have an alternative shortcut available. The shortcut we can also use, and sometimes we have to use when an investment has 100 same years of cash flows, right? Then rather than making a page, a chart of 100 different years, we will do a shortcut. The shortcut is we will use this formula. Shortcut is we're going to use this formula to do this understanding. So what's the formula here? That's the formula. This is the power of it, right? So 1 minus 1 plus r raised to power minus n over r. Okay, what is the way? What's the way? Look, one way is this. We can use the old technique, simple discounting technique. Or what's the second way that we have available to us? We can do like this. So we have an initial investment of 50,000. It's a 5 year of investment. So I say, okay, it's year 1 to 5. And I am going to get same inflows in the next 5 years. So what I need to do, I can simply sum of all of them. Okay, if I take is equal to the sum, if I take the sum of all of them, my God. And if I multiply this, if I find the NPV, what would you get? Same NPV you will get over here. Right? It's a shortcut, right? But I don't need to find like this by taking the sum of them. I can get this by using this formula. I mean, the sum of all of these I can get directly by using this formula. And in the exam, there will be a table available to you, the annuity table and the present value table. You can also use that table as well. Okay, let me use this formula first. Okay, so you should know how to use this in the Excel sheet because you're going to adapt your paper in the Excel sheet. Look, so formula is this. So how I will use it? 1 minus, okay, first of all, I will put bracket 1 minus 1 plus R. Okay, what is my rate of return? 10% here. So 1.1, right? 1 plus R raised to power, minus N. How many years? 5. 5. Okay, I will close bracket, close again, divided by R. R is again 10%. So 0.1 or 10%. 0.1. Look, same answer I will get. If it's 100 years, put N as 100. Okay. This is called annuity. When you have same cash flows for a number of years, this is called annuity. Clear? Okay, good. Then you have perpetuity. Perpetuity means same cash flows for an unlimited period of time. It may be possible you may have an investment that will give you unlimited cash flows. You don't know, maybe forever investment. Maybe you have a land, you rent it out on a same rent, right, for an unlimited period of time. So this is called perpetuity. And we also have a formula for perpetuity that we use 1 over R. Okay, so let's say here I have investment. Okay, this is a sign for perpetuity or infinity. Let's say we have an investment, and this investment requires 50,000 today, but it will generate, let's say, okay, let's say 10,000 a year, every year for infinity. So I will use a formula now 1 over R. So is it equal to 1 divided by R, which is 10%. 10%, or you can write 0.1. Okay, so 50,000. Okay, if your discount factor is, let's say, 8%, so divide by 8 or 0.08. So it gives you more answer over there. This is perpetuity. Annuity, perpetuity. Right. Now, let me discuss with you some other circumstances. Now, there may be possibility of some other investments. Let me discuss with you. Sometime you have advanced annuity. Okay, we discuss annuity and perpetuity. There's a simple annuity and simple perpetuity. Now we are going to discuss advanced annuity and perpetuity and delayed annuity and perpetuity. Right? What is advanced annuity? Look, by the way, normally we say cash flows will start from the year 1. Normally we say the first cash flows will start from year 1. Right? What if the first cash flow start from year 0, from now? This is advanced annuity, right? And in that case, what you have to do? Use the same formula plus 1. right? Because here I need to include year 0. And here's your discount factor is 1. Okay, so I have two ways. I can use the same formula. I will get my answer and then I will plus 1. Similarly, I can use my perpetuity same formula and whatever answer get, I will plus 1. This is for advanced annuity. Now, what is the delayed annuity and perpetuity? Okay, delayed annuity and perpetuity is, okay, let me start with delayed. Okay, let's say we have same cash flows, but it starts from year 3 onward. In year 1 and 2, we have different cash flows, or we have no cash flows, let's say. We have same cash flows, but it starts from year 3. Now, what should we do? Okay, we can use this method or we can use delayed annuity formula. Okay, what are the options available to us? One option is, look, better way is use the table. Look, the table will be provided to us in the exam. Okay, you can see the formula sheet in the exam. Let me show you the table. ACCA FM formula sheet. Yeah, this one. Yeah, we need to see all of these topics, but look here. You also have here the present value table. Look, there's a present value table and formula is also there. You also have here the annuity table. The formula is also there. Or you can use table as well. Okay. Okay, let me start with a different example. Let's change the interest rate as well. Discount rate as well, because we're using same rate again and again. Okay, let's say our rate of discount is 7%. Our discount rate is 7%. Okay, and we have, let's say, from year 0, 1, and 2. Okay, we have initial investment of, let's say, okay, 40,000. We have initial investment that we made, and in year 1, the outflow is 12,400. Inflow is 12,400, and then we get inflow of, let's say, 14,800, and then for the next 3 years we have same cash flows. Now, how we will do that, how we will attempt that, because these are same cash flows we can do in a shortcut way. Rather than saying like this, we will do, okay, 3 to 5. From year 3 to 5, okay, we are going to get the same cash flows. Now, how should I do it? First of all, here's your discount factor is always 1, right? Here, what I will do, 7% is rate, 1.07 raised to power minus 1, right? Or you can use the discount factor, 7% year 1. Okay, here it is. Okay, with the discount factor table here. So 7%, right? 1 year 1. So 0.935. I can use this as well. These are 3-figure rounded, right? But here you will get, so it's up to you. Okay, you can get the same table for the second year as well. Here we will use annuity. Okay, so I can use the same annuity formula, but I can check from the annuity table. So, okay, here is my annuity table. Okay, so what annuity I'm looking for? I'm 5 years of annuity at 7%, right? Is that 4.1? Okay, look, one thing is the annuity which is given here is a simple annuity. It is not delayed annuity. It is not advanced annuity. So this 4.1 is the annuity starting from year 1 onwards. What we need here? What we need here? We need annuity from year 3 onwards. So what's the best way? Look, first of all, find the annuity from year 1 to 5, which is available to us. How much it is? 4.1. 4.100. Now, subtract the first 2 years of annuity from it, because we need from year 3 onward. So year 1, 2, 2, I have to subtract from here. I can find by adding both, or I can find from here. is 1.808. So 1.808 I will subtract from here. Okay, and here I will get the annuity, sorry. 4.1 minus this. This is the annuity from year 3 to 5. This is the delayed annuity. This is how you will find the delayed annuity. Okay, this is one way of doing it. We have also a other way, but I will discuss it someday later when we move on. Once you're uh, expert with these approaches, right? Okay, there's also a kind of an investment. Let me discuss about it. Let me discuss about it. Let's say, okay, let's say you're going to make an investment today that cost you 200,000 today. Our discount rate is, let's say, 7%. The year one, okay, the cash flows that we expected here, with 4, 2, 4, 5, 6, 7, we have different, 8, we have different, and then we have again, sorry, 6, 7, 8. And maybe we have same annuity again, but okay, I will just stop here and now I'm finding the perpetuity. Let's say now from year 9 to perpetuity, you are going to get the same cash flows. So you have both of them, right? Annuity or maybe 3 times the annuity will come in one time, right? So, okay. So what's the case now? The case is 200,000 is the investment you're going to make now. Okay, 20,000 is the investment you're going to make now. It generate the different cash flows for 3 years. Let's say year one, it generates you, let's say 100. Let's say it's generate 19,000 for you in year one, and then again it takes 21,500, and then 20,600. Okay, and then for this time frame, you get the same cash flows of 17,000, and then the cash flows start falling to 15,000, and then 13,000, and then you expected 5,000 cash flows to be forever, right? So how should I do? First of all, these are the normal years. Here we will use our simple discount factor. Also here we will use our simple discount factor. Here I'm going to use delayed annuity, and here I'm going to use delayed perpetuity. Okay, how? Okay, 7%, 1 point. Okay, I can use 7% rate as well from the table. It's up to you. Raised to power minus 1. For 3 years, I will do like that. Here, 4 to 6. Okay, I will take first from year 1 to 6, and I will subtract from year 1 to, I need 4 to 6, right? So I need to subtract 3 years. So I will get from year 4 to 6. Mean for 3 years, I will get like that. I will take 6 year of annuity, then I will subtract the first 3 year of annuity, right? And I will get the last 3 year of annuity here. So, okay, so I will start with the 6 year of annuity here at 7%. So 4.767, right? 4.767. Okay, sorry. 2.624 minus 2.624. Okay, this is what I'm going to use here, right? Again, in year 7, I'm using simple discount factor. I just copy paste this formula in these 2 years, right? 1 plus r is power minus n. And here I will use perpetuity formula, but delayed perpetuity now. Again, as a delayed perpetuity. So first I need, okay, because perpetuity formula will give me the answer from year 1 to infinity, okay? The formula I use 1 over R, which is 7%. 1 divided by 7% or 0.07 is giving me 14.28. But this is from year 1 to infinity, right? I need from year 9 to infinity. So first 8 year of annuity I will subtract. Annuity. Yeah, of course, annuity. 8 years of annuity or discount factor we need to subtract. So how many 8 years? Here is the 8 years, right? 5.971. So 5.971, and that is what we will get, and that we are going to use here. And now we will find our present values here. How? Cash flows multiplied by discount rates. Them. And we still negative. So project should not be started. Okay, so we discuss annuity, perpetuity, delayed perpetuity, advanced annuity, advanced perpetuity. Any question? It's clear. Okay. NPV, as I said, if the project NPV is positive, we should accept the because look, if let's say this is 45,000, let's say, still negative. Okay, still let's say it's 50,000, still negative. It's 1,000. Okay, it's positive now. Okay, so this project has a positive NPV now. 46,745. What that mean? That means if we start this project today, okay, this is a present value, right? Or future cash flow. If we start this project today, our business value will increase with 46,745 today. So if the project NPV is positive, and if we invest, if we accept the project, if we invest in the project, it will increase the wealth of the shareholder today. So the rule is, if NPV is positive, we should invest in the project. If NPV is negative, we should reject the project. And if you have mutually exclusive projects, mutually exclusive projects, when only one project. Yeah, when you have maybe a lot of projects available, you have 3, we can only pick 1. Because of any constraint, because of we have shortage of funds, government constraint, resource constraint, skills constraint, we can pick 1. In case of mutually exclusive, we will pick the one with the highest NPV, okay? Huh? Highest NPV. Yeah, highest. So in case of our mutually exclusive projects, we will go with the highest NPV. By the way, if we can manage more resources, we look if we have 3 projects, 3 of them is giving the positive NPV, we should go with all the 3. But if we have restrictions, we have some problems, we discuss all of them later. Capital rationing is a problem. We have resource shortage. Then what we will do in that case? Of course, then we will go with the best of them. Okay. Okay, so we learn about the NPV first of all. Now let's talk about the second topic we have. We call it IRR, internal rate of return. And then we will do some questions. Okay, internal rate of return. First of all, I will explain you how to calculate it, and then I will explain you concept behind it, what we are going to do. Okay, just like the NPV is a method to appraise the investment, whether should we go with the investment or not. Similarly, the IRR is also a decision technique, right? It is also universally acceptable, like NPV. It's the other way of making a decision whether we should invest in the project or not, right? Okay, IRR we calculate using a formula. Okay, so let me first of all discuss about the formula that we use to calculate the IRR. IRR stand for internal rate of return. What's the formula for IRR? So formula for IRR. IRR is equal to what? L plus NL. Hmm, NL divided by NL minus NH into H minus L. This formula will be given to you in the exam formula sheet. Okay. Okay. What is basically here? L, NL, NH. So what is the meaning of it? Your L mean your lower cost of capital or lower rate. So lower rate. H is the higher rate. NL is NPV at lower rate, and NH is NPV at higher rate. Okay, so what that means? To find the IRR, we need to find NPV first, once again. But we need two NPVs. Okay. Look, to find the IRR, we don't need any discount rate. We can choose hit and trial method. We use two and we have to calculate two NPVs. Better if we get one positive NPV and one negative NPV. Okay. And then once we get it, we use the formula and we find the IRR. Right? Okay, let's do a question. Okay, let's do a question. Okay, let's say we have a 4 year of investment, not 5 years always. Let's say 10% I'm going to use first. The investment cost, let's say 40,000. Okay. So I need to find first of all two NPVs. I have this investment, which is going to take 40,000 investment today, and it generates this inflows in future. Now I want to appraise it using the IRR, internal rate of return. So for the calculation of the internal rate of return, I don't need any discount rate. Okay, I have to find two NPVs first. Okay, I take 10% and I find my NPV. It's a positive NPV. Okay, so the other NPV I need, which should be negative. Okay, how? I will take the same thing here. Okay. So I find one positive NPV. Let me use a different color to make it easier for you to understand. And now I will find another NPV here. Okay. So I use, look, if my first NPV is positive, so I have to increase the rate to get the negative NPV. Look, the reason is when you keep on increasing the rate, okay, this will reduce. This value will reduce. This value will reduce. Your present value will reduce. Let me prove it to you. Let's say now I want to find the NPV at 15%, right? 15%. So I'm using 15% rate of return, like 1, Here 1 is 1 always, 0 is 1. Here 1.15, right? 15 raised to power minus 1. Okay, you see, it's 0.90, now it's 0.86. When you multiply, it will automatically decrease. Okay, so I will find for all of them, I will find the present value. Look, same cash flows I use, but I multiply them with a new discount rate, 40,000. Right? And find the NPV again. It's a negative. I find one positive NPV and other negative NPV. And then what I do, I will apply the formula. Look here. To find this, I use this two rate, right? So first of all, what is my lower rate here? 10%. We have two rates, 10%, 15%. Higher rate, 15%. What is NPV at lower rate? Right? What is NPV at higher rate? Just put this in the formula and get your answer. Right? Just put this in the formula and get the answer. Okay. So if this is the formula and I want to put it, so how I will solve it? Okay. So what is my lower rate here? 10%. So I can do like that. I can use decimal as well. 0.1 is up to you. Then everything should be in decimal. NPV at lower. Okay. It is 1830 divided by NPV at lower 1830. We have formula minus, and this is already in minus. So minus minus will become plus, right? So keep in mind. Or when you use Excel, they will automatically do it. Okay. So 2384. Okay. And multiply by the higher minus lower. So higher rate is 15%, right? And minus lower is 10%. You have to find it, and whatever answer you get, you add into it. That is your I. So the good thing is in the exam, you can use Excel sheet formulas as right. So if this question comes in section B, then you don't have access to Excel, right? Or in section A, maybe you will get MCQs based question. Then you have to use formula. But if it comes in section C, then you will use the Excel formula is equal to IRR, start, and just give them the references cell. Here, write all the data in years. I mean, should be in sequence, right? And close. That's the IRR. You get the answer same, by the way. Approximately same you will get. It's 12.06 or 12.1%, we can say that's the IRR. So you can use Excel formula in the exam as well. You can use this formula as well, whichever you like. So the rate of return, the internal rate of return, the IRR is 12.1% of this project. Okay, so first we understand how to calculate the IRR, right? Is it clear? First we understand how to calculate the IRR. It's clear to everyone, right? Now we explain what it means. Look, IRR, the name says itself, internal rate of return. So this 12.1% is the return of the internal return the projects. It's the return of the projects that it generates. Return. So this project gives you a return of 12%. So what we have to do? We have to compare it with our cost of capital. Okay, so the methodology is that the decision rule is you find the IRR, and if your IRR is more than your cost of capital, project should be, if return is more than the cost, project should be accepted. And if the IRR is lower than your cost of capital, project should be rejected. That's the rule. So yeah, I'm coming to it. Yeah. So IRR is basically giving you the internal rate. Or in the other way, we can say and IRR is the rate where your NPV is zero. Is right. Look, let me explain it to you with the help of this chart. Okay, by the way, I can draw it as well. Look, so if I want to draw a chart between the NPV, look here, NPV is on y-axis and cost of capital is on x-axis. We discussed, we find the NPV at 10%, right? At 10%, which was positive, right? And we find the NPV at 15%, right? It was negative here. So IRR is basically a formula that use interpolation. Okay, interpolation, you just need to know here is a concept of economics and stat, I think. But we don't need to go in detail. So interpolations basically mean finding a point between the 2 points, right? So basically we find a positive NPV, a negative NPV, and on the basis of that, we find the middle point, right? This point, which is 12%, 12.1%. Now, so my internal rate of return are the return where we are at no profit, no loss, right? At break even is 12.5%. So if my cost is 10%, it's good and worthwhile for me because I will be at profit, right? Simple. So the rule is if your IRR is more than cost of capital, project should be accepted. And if it's not, rejected. And in case of mutually exclusive projects, go with the higher IRR. Right. Now, here we need to learn some advanced points as well. Okay, so as I said, interpolation concept. Okay, the interpolation theory says if we have a straight line, then it is easy to find the middle point if we know the two of the point of them. Okay, let's say here, once again, if I draw like this. Okay. Here okay, I'll put my cost of capital. And here I put my NPV. Okay, here zero NPV, here positive NPV, and here negative NPV. And we believe that we have a straight line relationship. Okay, we find a positive NPV, we find a negative NPV, and then using the interpolation, we find the middle point. The formula is the interpolation formula of the IRR. But the problem is the actual IRR is not like this. The actual, okay, you know that as my cost of capital increase, my NPV falls, right? And this is a point where my NPV is zero. But the actual line is not like that. The actual line is curve. Like you see here. It's not a straight line, it's a curve. So, but what we assume, no, it's not a curve. We assume it's a straight line, right? So we find the middle point assuming a straight line, right? But it is not a straight line. I mean, let's say we pick a point here and we pick other point here and we use interpolation. Guess which point we find out as a IRR? The middle, but the straight line point. This is the calculated IRR. Yeah, using the formula. But this is the actual IRR. Huh? No, we can't get actual IRR. The formula gave us the calculated IRR. I'm explaining you the drawbacks of IRR methodology. The formula that we use in the interpolation, they gives us the estimated IRR, which is close to the actual IRR, but not the exact IRR, right? So look, the more close, so that's why try to find the IRR. First, find the two NPVs which is closer to zero. Because look, if you find 2 points closer to zero, then you find the more appropriate IRR. For the point, right? Look, now we have a topic. Look, I'm explaining you the syllabus. I will explain it from textbook as well. We have a topic about NPV. What is the benefits of NPV, drawbacks of NPV? Okay, the advantage of NPV are huge. We discuss about it uses time value of money. It is based on future cash flows. It uses cash flows. It uses the entire life of the project, right? It's incorporated. I mean, all of this thing. The IRR also have the same benefits because it also uses time value of money. It also uses the entire life of the project. Okay. But we have a topic as well, syllabus requirement, where we have to compare both the NPV and IRR, comparative wise, which is better. So comparatively, if you want to compare the NPV and IRR, both method are universally acceptable. But NPV is technically superior than IRR. Reason? One reason is this. Other reason, in case of mutually exclusive projects, NPV is superior approach. By the way, both methods give you same decision. I mean, look, if NPV is saying go with the project, NPV is positive, IRR will also give you same decision, but there are certain exceptions. One exception is when the cash flow pattern are non-conventional, you will get multiple IRR. Okay, what is the meaning of non-conventional cash flow? Okay, let me explain you first of all. What's the non-conventional cash flows? Okay, okay, whatever cash flow pattern I studied with you, I discussed with you, like these. These are the conventional pattern of cash flow. What that mean? Mean you have outflow only in year zero, and then later on you have positive inflows. You have no outflows. When you have no outflow, only you have outflow today, and you have no further outflow. You have a conventional pattern of cash flow. Just keep in mind. But if you also have outflow in other than year zero, let's say here, you need to invest further, maybe 12,000. Outflow is expected. No, it is a non-conventional pattern of cash flows. 10%. Yeah, maybe possible. Like, for example, you need to invest today, and after 3 years, you need to change its engine. Let's say, possible. This is a non-conventional. So in that case, IRR approach will give you multiple IRR. Like what? In that case, you might get the IRR line like this. So here you have two IRR. By the way, you don't need to calculate at this level in FM level, but you need to know about it. Examiner might ask you in theory. Okay, here we have two IRR, but we might have more than two. Like for example, what about this? We have so many IRR. That's why it caused confusion. If decision maker not know about it, they might make a wrong decision. So let's make a comparison. Here, I made a comparison from the old book. So when cash flow pattern are conventional, both give the same decision. Yes. If pattern are same, I mean, if there's a conventional pattern, both the NPV and IRR same gives you the same accept and reject decision. Okay. The IRR method is easily understood. Look, because reason is IRR gives you answer in percentage. And NPV it gives you answer in number. So especially it is difficult to explain NPV approach to a non-technical person. Look, we may have some non-technical manager as well who don't have accounting background, finance background. So it's difficult to explain. Okay, we find the cost of capital, we discount it, they will not understand. But if you say IRR, what is IRR? The rate at which you are at no profit, no loss. At least you can easily explain it. right? NPV is technically superior, as I said to you. IRR in accounting, ROS can be confused, right? ROS, ROS is also in percentage, and IRR is also in percentage. So decision maker might confuse, huh? It's maybe, no, it's not the same. ROS is the return on capital employed. It's different. It's a ratio, but IRR is something else. IRR ignore the relative size of investment. Look, no, this is, if you want, we can do a break right now, right? Or let me finish it. Just give me 2 minutes, right? Look, there are two types of measure, relative measure and absolute measure. Relative measure, absolute measure. Look, relative measure is any measure that give you answer in percentage, a ratio, like ROCE is a ratio. IRR is in percentage. So when you find answer in times, like current ratio is that in times or in percentage, this is the relative measure. And when you get answer in dollars, in whole number, this is called absolute. Both have its drawbacks and plus points. Look, the benefit of relative measure in percentage is it is comparative. If I ask you, what is your marks in the FM? What is your marks? What is your marks? Right? For example, what is your marks in O level, A level, let's say? Okay, he said, okay, 800, 1200, 500. But he said, okay, I have 800 out of 1,000. He said, okay, I have 1200 out of 2,000. I can't compare. To compare, what should I do? I should convert all of you marks in percentage. So comparison is always possible when it's in percentage. But problem of percentage, it ignore the size. Look, ROC, you have two investment. One is in millions, one maybe in billions, but both give you same IRR. Both give you same ROC, let's say 10%. You ignore which investment is required. So the relative size, relative measure is easy to compare, but it ignore the size. Look, it ignore the relative size of the investment. On the other side, absolute measure is it will not ignore the size. NPV is in percentage. No, NPV is in dollars. It's not ignoring. You're not ignoring the value, but it's not easy to compare. Okay, so we have these two things. Okay, next. When cash flow patterns are non-conventional, there may be several IRR which decision makers may be aware to avoid making. Okay, this is what we discussed. NPV method is superior in ranking the mutually exclusive projects. I discussed it. The reinvestment assumption underlies the IRR method cannot be substantiated. Okay, this concept we will discuss someday later. Okay, I'm not going to confuse you today. When discount rates are expected to differ over the life, yes, possible. Discount rate is not going to remain the same. 10%, 5% might change. So that such variation is easy to incorporate in NPV because NPV is just one NPV. IRR, if you want to recalculate again, you need to calculate two NPVs again. So of course, extra work is needed. By the way, today we are using Excel, we're using ERP system, so it will be system generated, not a problem for us. Despite the advantage of NPV method, IRR method is widely used. So we have both methods, both are widely used in practice, right? And okay, so we will stop here. And okay, have a 10 minutes break. Project are easy. Okay, let me do it. I will do, okay, the first three, let's say with you. NPV. Cost you don't need. Cost of capital, look, for NPV we need. For IR, we don't need. Look, he mentioned now. Look, for NPV, we need the cost of capital because without that, how could we find NPV? For that is specific. Look, he mentioned the company discounted all project of 10 years duration or less at 12%. And if it's more than, then 15%. So, so this is the less than 10 years. So we use 12% as the cost of capital, right? So look, we can do like this as well. Yeah, like this. There's a format that we mostly use in the exam because we have so many things comes up in that. So this format is much better. 3, 4, and 5, something like that. Here, look, all the cash flows. So how much we have? Okay, here write initial investment first. Okay. Initial investment. Okay. Okay, so initial investment is 29,000. We have to make now. And it generates the following cash profits. Okay, so these are the cash profits given each year: 8, 12, 10, 6. And then he said the project would be resold. So it's a resale value. We need to take the cash flows and all the relevant cash flows, the relevant costing concept you have covered in your MA paper somehow. Or if you have paper, if you have learned the PM paper, 5 paper, you know about the relevant costing concept. Okay, but I'm going to explain you a bit that is needed in our framework. Okay, so relevant cash flows mean all the cash flows which is relevant to the decision, relevant to the project, we need to consider in it here, right? Okay, so scrap value, you also need to take. How much it is? 5,000, right? Yeah, 5,000 in the end. Yeah. Okay, so now we'll find the net cash flows. Mean net mean all of them. I will net. Yes. Okay. Yeah. Then your discount factor, which is 12%, right? At 12% is what? 1.12 raised to power. You have to in this way in the exam, right? By the way, this is a very basic question, but I'm just giving to give you the introduction, like how. Discount rate. Here 0 is 1. And then present values multiplied by the discount factor. Right? You will get this NPV sum of all of this. So NPV is positive, project should be accepted. So this is the one question I did. Okay, second question, okay, project B. Okay, let me see, because I want to show you something else. Look, here now he give you a lot of things. Sales, variable cost, contribution, fixed cost, profit. So look, we need to take relevant cash flows, inflows, outflows, any cash sales, any variable costs. Look, you know what is contribution, right? Sales less variable costs is contribution. So there's no need to mention. You can write sales less variable costs, but I will start from contribution here. Okay, because those already the net value. And then I subtract my fixed cost. But he mentioned down fixed costs include annual charges of 4,000 for depreciation. Depreciation is not relevant, is not cash item. At the end of a third year of working capital, okay, working capital, I'm coming to it. No, project B would involve current outlay of 44,000 on capital equipment and 20,000 on working capital. What is working capital investment? Inventories. Look, you're going to start a new project, a new product you're launching. So you need to have some inventory with you, right? Working capital investment needed. Okay, and normally it is recovered when the project is over. Look, he mentioned you need, okay, let me explain it. Let me do it for you. Okay, we will do the same thing. First of all, years. Okay. Okay, I will start with first of all my initial investment. and my working capital investment or working capital requirement, right? That I need. How much I need? 44,000 is the capital and 20,000 working capital. 44,000 outflow and 20,000 outflow. 1,000 outflow. Okay, and then look, we have contribution. And look, he said fixed cost is 4,000. So I remove 4,000 from here because it's fixed cost, which is not cash flow. At the end of a third year, the working capital investment would be recovered. We have 3 years. And the equipment would be sold for 5,000. Okay. So all the working capital investment, we have 3 years of project will be recovered by the end of third year. That means we refund the money back and all the inventory will be sold. In the exam, whenever he mentioned working capital investment, normally he will tell us it will be recovered or not. But if he not, it's your assumption. Okay. Normally you have to recover it. Right? So, but write it down, assuming that the working capital investment will be recovered at the end of the period. Right? Okay, we have working capital investment done. And we also, our initial investment, we have a scrap value. We can write down here or we can write separately, no problem. Scrap value. Scrap value. How much we have? 5,000. Okay, and then, okay, normally we take these things in the end, always try to mention these things then. Any profit, show it first. Why? Because in later on, taxation will come up, inflation will come up, many other things will come up. So it will be tricky, right? Because tax is also relevant cash flow. Look, if you make profit, you have to pay tax on it. It's also relevant. So that's why take initial investment, working capital investment, scrap value in the end, and any profits take first. Okay. So look, I have sales, less cost of sales, whatever you want to do whatever. Okay, let me say sales, and then we have variable costs, variable cost, and then we have fixed costs, right? So take all of them, but only those which are relevant to decision making. Okay, so sale is 75, 90, and 42. 75, sorry, not year zero. 75,000, 90,000, and how much? Last year, 42,000. Okay, variable cost is normally, if it's not mentioned, is relevant. Fixed cost, if it's not mentioned, normally it's considered as a irrelevant because it's normally fixed. It's not going to change. Incremental fixed cost is relevant. Okay, I'm going to explain with the help of example now why. Variable cost is mentioned here. 50, 60, 28. 50, 60, 28. Put proper zeros, more zero. 60, right? Minus 28,000. Yeah, that's it. And fixed cost, I will take only relevant. So depreciation is not a cash flow, so I will subtract. So 10 minus 4, 6, and 4,000. Okay, now I will find here net cash flows. Net cash flows. Just take the sum of all of them. Okay. Discount factor again at 10%, 12%, right? Discount it. This is year one, by the way, 1.12 raised to power minus year. Present values. This is how you will do in the exam. And NPV. negative, so project should not be accepted. Like this. Okay, third is also same. Project C. Okay, initial investment 50, equipment, and 15,000 working capital. Okay, what he says next? Investment in working capital would increase to 21,000 at the end of the first year. Now here, two important point I want to raise with you. Look, there are some assumptions which is related to working cap, which is related to the investment appraisal. And these always you have to follow. Okay, what are the assumptions? Number one, in the question, if it's mentioned, we first of all, we look, when we do discounting, we always assume cash flows arise at the end of the year. He might mention, okay, cash flow arises in the mid of the year. So we assume no, at the end of the year. So if cash flows arise during the period, then it is assumed that it arises at the end of that period. If cash flow arise at the start of the period, look, he mentioned we have a cash flow on 1st January 2024. So we will always need to take at the end of the year. So if it's on 1st January 2024, we assume it's happened on 31st December 2023, the next last day. So if cash flows arise at the start of the period, then it is assumed as if it arises at the end of the preceding year. Always remember that. This is a basic assumption. You can make a mistake in the exam. If we say start of year 3, that means end of year 2. Start of year 1, 0. Right? Initial investment is 0. Okay, initial investment is in year 0. Or today, okay, is in year 0. That means now, right now. If he didn't mention, like, okay, we have initial investment of 10,000. He didn't mention when. So we assume it's year 0. And period 0 is not a period. It's just like today date, right? Or is the start of a year 1. So keep this in mind. Now look here. Look here. In project C, 50,000 investment required on equipment and 15,000 working capital. It's initial investment. 0. The investment working capital would be increased to 21,000 at the end of the first year. Okay, that means year 1. Year 1. So, okay, so here what happened in this question? Okay, if I want to do it. So you have working capital investment as well, right? You have working capital investment as well. Let me say, forget about it. So initial investment, he mentioned 50,000 and 15,000. 50,000 and 15,000. But what he say? Working capital investment increased to 21,000. I mean, what is working capital investment? Your inventory investment, and also you give credit to customer. There's also investment, right? Your money bound with them. And then he said, this bound investment need to increase to 21,000. So 15,000 already there. It's not wasted. How much more we need to invest? 6. And so how much total? 21,000. How much life of the project? Okay, he said annual cash flow of 5 years. Okay, so 5 years. 4, 5. So after 5 years, if he mention or not mention, 21,000 you will write as an income. If he specifically mentioned that working capital investment will not be recovered, yeah, then you don't need to take it. Okay, and then what you have? He gave us the profits. How much? 18,000. So you can use annuity for this as well. It's up to you. Okay, you can use annuity, or up to you. So he gave us the profit itself directly. How much? 18. Just take it every year. 18,000. Yes, like this. And then discount it. And find the NPV. positive. So investment should be accepted, right? That's the one kit. Now, we have one more thing, and we will move to the text working, or we can do something else as well. Text working, I think we should start with next class so that you can practice. Uh, now, we have an idea of relevant cash flows, relevant costing, relevant cash flows. Look, this is a very, very important idea. Whenever we make decisions, whether short-term decision, whether long-term decision, we make decision based on a relevant costing or relevant cash flows. Okay, I'm going to explain you that, for example, right? What is the relevant cost, a relevant sale, a relevant cash flow? It must have these four features, all four. One of the four is missing, is not relevant. Okay, which four? Number one, relevant cost, relevant cash flow. It must be a future cash flow, because if it's happened, you can't control it, right? I mean, let's say you're going to here, like I created an example here with my old student, and which is this example is basically about. Here, let's say the GBS Institute, the GBS, they are thinking of starting a new project, a new course. And which course it is? A different course. Uh, they are going to start the driving classes, let's say, right? And now the management is deciding, should we start the driving institution or not, right? So for that, we have these costs. For that, we have these costs we estimated. Okay, number one, we already conducted a survey. Okay, so because we are going to launch the driving institute as well with the name of GBS. Now, the first thing we want to know what's the market condition, right? I mean, whether students are there, how many market, how much demand is there, what's the competition level, how many institutes are already there, how much their revenue generation, right? So for that, we hire a agency who conducts survey on our behalf. Okay, we have to pay them 10,000 dirham for this survey, but in 6 months time. But the survey has been done for us. Now, the survey results were very successful. We are standing here now. Okay, please understand my example, right? Because I'm going to explain you what is the relevant cost from them. Okay, so we are still deciding, should we go with the driving classes course or not, right? We conducted a survey, but the amounts yet to pay. Now we are planning, the management is planning, if we start with the driving classes, first of all, we need to get a new license because the current license is not valid for that. So licensing and legal fee cost is 15,000 dirham. We have to buy vehicles as well. It costs us 40,000 for 4 vehicles. We have to hire instructor as well, right? We need staff member as well, right? Of course, other technicians and helping staff, support staff, sales staff, marketing staff. So we need 10 staff, 10 of them we already have, and they're getting a salary of 100,000 a year. 4 new staff member we need to recruit. A rent building, existing building is enough to accommodate the new course as well. And the rent is we are paying is 100,000. And if we initiated the class, we will generate a revenue of 400,000 a year. Now we need to decide which of these are relevant. Okay, so I'm telling you, relevant costs are those which are future. Number one. Number one. Number two, it must be incremental. Incremental means arise due to decision, directly related decision. Number three, avoidable. Avoidable means if you will not take the decision, you can avoid. Right? I mean, look, you have to pay the licensing cost. If you make a decision, yes, yes, we should go for it. If you know, you don't need to. It's avoidable. Number four is it must be a cash flow. Okay, depreciation, bad debts, right? Fixed costs, which is not, we don't need to consider. We only need cash flows. So all the four characteristics must be there. One of the four is missing, it is not relevant. Right? No. Tell me, Which of these costs are relevant? Tell me from here. What about this?
No.
Is irrelevant. Why? You have to pay in future.
No. Committed research cost.
Yes, it is a committed cost. Look, it is a future cost, but it is not avoidable cost because survey has been done. Yes, you have to pay in future, but can you avoid it?
No.
The question is, if you go with the decision or not, you can't. Yeah, but if I say, let's say, if I say I am standing here, now I am thinking, should I go with the driving classes or not? If we go, we have to conduct survey. We haven't appointed someone yet. Now it will become relevant, right? So where we are standing is really important. So right now, because the invoice is with us, the survey has been conducted. Now, whether we will go with the driving course or not, we have to pay it. So a committed cost is a future cost, but you can't avoid. Yes, is irrelevant. What about this?
Relevant.
Relevant. What about this?
Relevant. Relevant.
Yes.
Irrelevant.
Current staff irrelevant. Why?
Already.
Yes, they're already employed. They're already getting 100,000. Look, whether you start the driving classes or not, you still have to pay. Irrelevant. But the new staff will become relevant. You only have to recruit them because of this new course. Okay. Rent, irrelevant. But if we say, no, the current building is not sufficient because this is not in the locality where we can initiate the driving classes, then we need to rent out a new building. Then it will be the relevant cost, right? Revenue will be relevant here. Now we have a question which incorporate the relevant costing as well. Look here. You can do all of these questions. I will show you, by the way. No, let's try this question. Please try this question. What we need to do, we need to calculate the NPV again. We have 10 marks for this question. Okay, we have to find the NPV here. Okay, here the question start. Yes. The cost of capital is also provided. We do it together, but first read it. We do it together. Let's read it first. And highlight it. What do you think which is of the cost is relevant and which of the cost is not relevant? Okay, let's read together. Mazda is currently considering the launch of a new product. Okay, the market survey has recently commissioned, sets the likely demand for the product, and this shows that the product has an expected life of 4 years. Okay, the survey cost of 30,000, and this is due to be payment info. What about this? Relevant? Hmm? No, it is irrelevant because survey has been conducted. You have to pay in the future. So you don't need to include it. It's a sunk cost, by the way. A sunk cost is a cost that you paid already, but okay, you didn't pay it. It's a committed cost, yes. On the basis of the survey information as well as the internal management accounting information, the assistant accountant prepared the following profit for cost. Okay, so this is a profit for cost we got. Sales, cost of sales, gross profit, variable, fixed, market survey. Look, this is wrong. This should not be there. Okay, market survey should not be there. Net profit and loss, whatever. Okay, these profit forecasts were viewed with disappointment by the director because you see, it's in losses. As there was a general feeling that the new product should not be launched. The chief executive pointed out the product achieved profits is only 2 years in the 4 year life, and that over the 4 year period as a whole, net loss was expected. However, before a meeting has been arranged to decide formally the future of the product, the following additional information become available. Number one, the new product will require the use of an existing machine. Okay, we will use an existing machine. This has a written down value of 80,000, but could be sold for 70,000 immediately. If the product is not launched, look, which costs are relevant from your earlier study? Opportunity cost is relevant, right? Incremental cost is relevant. Differential cost is relevant. Committed cost is not relevant. Sunk cost is not relevant. Imputed costs are not relevant. You know all of these? Okay, you know all of these, right? Good. Then good. Look here. You bought you have an existing machine. Its carrying value is not relevant because it's past, it's sunk. You paid. And its cost, less depreciation as well. It's not relevant. Yeah, 70,000 you can sell immediately. But if you launch a new project, if the project is launched, it would be sold at the end of the 4 period for which amount? 10,000. That means it is relevant. Look, you can sell it for 70,000 now, right? But if you wait for the project and you sell at the end of the project, you will only sell for 10,000. So you're going to lose 70,000 now and you will get only 10,000 in the end of the period. Effectively, you're making a loss of 60,000. Why? Because of this project. So we need to include this in our decision making as well. How? I'm showing you. Okay, additional working capital of 20,000 will be required immediately. This is going to be taken year zero immediately and will need over the 4 period. It will be released at the end of the period. It's the same working capital investment. The fixed overhead. Look here, we have fixed overhead. So fixed overhead include a figure of 15,000 for depreciation. Wrong, it should not be included. And 5,000 for the reallocation of overheads. You know, overheads is totally irrelevant. Okay, overheads what? You have head office, you have this office. So we apportion the cost to them. No, it's not relevant. These are the head office cost. So how much? 15 plus 5, 20. 20 we have to remove from here. So it should be 5, 5, 5, and 5. And then we have to discount at 10%. Okay. I'm showing you the answer, right? It's not difficult. Easy question. I'm showing you the answers here. Okay. Every question answers I already uploaded here. So, okay, here's the mission. Okay. Okay, sales, no information. So it's look like relevant to me. All the sales, cost of sales, variable cost, fixed cost. I just took 5,000, right? Out of there were 25,000, but 20 was irrelevant. 15 was depreciation. 5 was the allocated overhead. I remove it. Look, how? Look, I will not just mention, look, the machine, which is opportunity cost. If I will not sell now, I will lose this money now, but I will get this money after the end of the 4. Don't make 60 and write in the beginning, no, because we have timing difference. We discount 70 at different discount rate, 1, and 10 at different discount rate. If you use different cash at different years, you make a wrong calculation, your answer will be wrong. And you will lose marks in that case. Okay, working capital investment 20 now, and how much left at the end? 20. Okay, he find the discount rate, he find the present values, and then he find the NPV. NPV, I think here's the NPV. Yeah, this one's the NPV 5.11 or 51,100,000. That means 5110. So it's a positive NPV. We should accept the project. Look, so this question you can do. Yeah. Because yeah, because it's a cost rise due to this project. Look, let me give you an example. Yeah, yeah, let me explain. Look, you have a machine. Its book value is 80,000, which is not relevant. Now, look, if you use the machine in this product, you can use it. You have two options. You can sell the machine at 70,000, or you can use in this investment, in this project. If you will use in the project, you cannot sell it for 70,000. You will lose it or not? Yes. If you don't initiate the project, can you save the 70,000 or not? Can you save this? So this is opportunity cost arise due to this investment. Let's say he said, At the end of the year, we have wasted, machine will be wasted. That means 70,000 will be considered as an opportunity cost. No, that's it. Now he said, okay, we are losing 70,000, but at least after the project end, we can sell it for 10,000. So that's why we take 70,000 as an opportunity cost now. And by the end of the project, whatever we can scrap it, we will use as an inflow. Understood? Look, we have other questions. Look, understood, right? Now, you have third question. This is also very do it. Answers are there. So first, you can do this question as well. You can do, no, not this. So the question number, the eight, question number seven, we did, by the way, and question number six. This is your assignment to do, right? Now, let's move to the two other approaches. So we have four topics, basically. We have four methods that we use to calculate, sorry, that we use to appraise our investment. So two of them we discuss, and we still discuss in detail in future, right? Because we just study the basic stuff. Now we need to incorporate two more things into it: the taxation and the inflation. How we accommodate it, that's we learn in our next class on the coming Friday. But we have two other ways to work out to understand the investment should be accepted or not. One is the payback period, and the other one is return on capital employed. Let's talk about these two as well, so that we can finish the chapter as well. What is the payback period? Okay, these two approaches are not advanced approach, basic approaches, right? You are not going to rely only on these two approaches. These approaches can be used in the initial phase. Look, as I said, you might have maybe 100 of investment opportunities available, right? So you need to first of all see which of them we need to pick. So as an initial screening, we might use these two approaches, ROCE or payback period, especially payback period. Okay, what is payback period? Let me explain to you. Okay, let's say here is my investment. Okay, I need some. Okay, here, payback period. Payback period. Okay, let's say we have an initial investment of 50,000. Okay, so cover 14,000 year one, 18,000 year two. Okay, 2,000. Okay, let's say there's an investment opportunity we have. Okay, and I want to find payback period. Okay, what's the payback period? It's very easy. I want to know only how long it will take to recover my initial investment. Okay, how much I invested in this project? 50,000. So I am only interested to know how long it will take to just recover my initial investment. So how I will calculate? Very simple. Look, I will make a third column with the name of, okay, cumulative cash flows. Okay, I invested 50,000 now. So how much recover first year? 20,000. How much left to recover? 30,000. Just minus, yeah, 30,000. Okay, then how much we recover second year? 18. How much left to recover? 30 minus 18. Okay, I will make plus in Excel because it's already minus, right? So 12,000. And I see here I'm going to recover the remaining 12,000. So payback period is somewhere between 2 years and some fraction of the third year. Okay, so payback period is, so this 2 years And how I will find the fraction here? How much I need to collect for? More? 12,000. How much we receive in this year? 11,000. Just find the fraction. So how much? 12,000. Yeah, divided by 23,000. So 2.5 years approximately, we would say that, right? So we will say that the payback period is 2.52 years. Or if you want to find in months, multiply this with 12, right? Yeah, approximately. So multiply by 12, you will get approximately 6 months. So we can say 2 years and 6 months. That means this project will recover its investment in 2 years and 6 months. There's a payback period. That's it. Look, the benefit of this method, easy to understand, easy to calculate. Cash flows, it uses cash flows. Drawback, it does not use the time value of money. Discounting is not there. It does not look at the entire project. It just look at the cash flows before the payback period. It ignores any cash flows after that. It's a simple method. We are not going to rely only on the payback method. Yeah, but it will focus on those projects which are less risky. Look, as soon you recover your initial investment, more like less risky for you, right? As it takes more time to recover initial investment, more risky. Those projects are more riskier, which take more time to recover the initial investment, right? So from that perspective, when you are risks reverser, maybe you will consider this as well. But look, we have a concept of economics, low risk, low return. So if you are taking less risky investment, maybe your investment's return is also not high. Okay. And the second thing, as I said, it ignores the time value of money. That can be incorporated by including the discounting in. So we have two types of payback. Simple payback, that is a simple payback. The second one is the discounted payback. Okay, so if I want to find discounted payback, same principle, but the only difference is, first of all, I will discount them. Okay, not here. So I will take my discount factor. Okay, I'm finding my present value directly at, let's say my discount factor is 5%. Okay, at 5% discount factor. So, okay, I'm finding it. Here, this is the same, by the way. Okay, here, how I will do? Okay, 20,000 into 1.05 raised to power minus n. Okay, I'm finding directly, right? You can use discount factor and present values up to you. I'm multiplying directly. You can do same like this in the example. Okay, so these are the present values. Now I will find cumulative present values. So instead of cash flows, I will use present values. That's it. Okay. How much required to collect? 50,000. How much you collect first year? So just subtract it. Okay. Left to recover this. How much you recover further? 14,000. Next year, still not cover. Here we expect it to recover. But no, we recover. So we recover. By the way, discounted payback is always higher than the simple payback. Reason? Discounting values are low than the cash flows. That's why. Discounted payback will definitely always be higher than the basic payback, simple payback period. So how much payback you are expecting to get? Again, 2 years, but some more month you will get. Okay, we expect to recover 14,626, but we recover 19,868. So 2.73 years, or if I want to find in months, multiply with 12. 2 years and approximately 9 months. So payback period is another approach that we use, right, to appraise our investment. It is not an advanced method. You are not entirely make a decision on the basis of payback method. Now, the last technique we have is return on capital employed, right? Let's look at the last one. In short, we call it ROS. You learn this ratio in your previous paper as a performance measure. I mean, we use it to measure the performance of a company. It is one of the profitability ratio. And the formula that we used is profits over capital employed, right? So the profit PBIT normally we use here, PBIT are profits divided by capital employed. And what we do, we multiply with 100. Okay. That's the formula we use to find the ROC. This formula we just use to work out 1 year of last 1 year of ROS for the performance appraisal. We are not going to use this ROS in investment appraisal. Formula is almost the same, some difference. The ROS you learned before, this is for performance measure. But ROS that we are going to use now is not for performance measure. It is for investment appraisal. We are going to find future ROS of the investment for decision-making purpose. Look, unfortunately, we don't have only one formula for ROS. Okay. Normally, examiner will give us the formula. If he asks you to calculate ROS, he will give you the formula. Okay. But if he will not, then we will only use this formula, which is what? Estimated average annual profits divided by estimated average investment. Okay. If it's not given, you have to look here. The same formula. Look, the first one. Okay, average annual profit. Look, here he didn't use average investment. You can use initial investment as well, but you don't use it. If you specify only, you will use it. Okay, which is this average profit over average investment. How you will find the average investment? This formula. Initial investment plus scrap value divided by 2. This is a formula you will use to find the average investment. Look, I mean, let's say you buy a machine. Okay. So today you buy for 50,000, right? The life is 5 years. After 5 years, you can be scrap for 5,000 only. So how much average? Look, so when you buy, okay, you buy for 50,000. Okay. And later on, you will sell for 5,000 only, right? So approximately you have to add both and divide by 2. In the beginning of the period, the value was 50. At the end is 5. So 55 by 2. That's it. So formula, initial investment plus scrap value divided by 2. Okay. And because this is the profit, so you have to do depreciation as well. Okay. That's the thing. Look here. We have a question. An asset costing 120,000 is to be depreciated over 5 years to a nil residual value. Profit after depreciation is given. Okay, it's already given. We need to find estimated average annual profit. So add all of them and divide it by 5 to find the average annual profit, right? We are looking at the entire project, right? So take the entire project profit and then divide it by life. So you will get average profit, 20,400. And then take the average investment. Okay, we have zero scrap value. So initial investment, 120. Scrap value, 0. So 120 plus 0 divided by 2, 60,000. So initial this divided by this. So ROCE is 34%. normally we have a target ROS. I mean, if we are going to appraise our project on the basis of this only, then we have a target ROS. So those investments that cover, that's meet the target ROS or above it, let's say our target ROS is 30%. That means this project should be accepted because it's covering its ROCE is more than our target ROS. Same with the payback period. We might set our target payback, let's say 5 years. So any investment whose payback is 5 and below than 5, we accept it. And any which is more than that, we reject it. But as I said, these both techniques are not detailed and we are not 100% rely on it. We are not going to make our total decision only on the basis of that. Okay, that's the ROCE. This I will bring, you can try this. I will bring some more questions for ROCE and payback period from the past exam paper in next class. So if you have any question, you might ask me.